It has been a fantastic year for Netwealth, and we're extremely happy with the results that we released earlier in the week. It was a bit of a slow start, as some of you may have seen, but it was nice to have seen it bounce back. A couple of highlights just to kick off the discussion. We reported $28.5 billion of funds under administration at the end of December. We had a very strong quarter with $4.4 billion of new money coming into the platform and a total of $9.5 billion for the calendar year. From a financial perspective, pretty much 20% plus growth on all of our key metrics. So underlying EBITDA of $30.5 million, up 22.8%, underlying EBITDA margin of around 52%, and underlying NPAT of 20.6 up and the margin of 36%. From a strategic perspective, we can continue to invest heavily into the platform, and a real focus for us as a business is expanding our offering into what we call whole of wealth. And that's really around collecting more than just a client's portfolio or superannuation and investment portfolio. We're looking at multiple data sources. We're looking at helping advisors aggregate their bank feeds, external superannuation, challenger annuities, and making it really easy for our customers to understand their full financial picture. So what we're calling, if you like, a live balance sheet. Pricing has obviously been fairly topical this week. We announced that we announced new rates for our retail product range, the Accelerator range. I just want to stress that the last time we released rates to the market was 2012, so 8 years ago. A lot's happened in that time, and you guys would all be well aware of that. But it's really important to understand that the rates that have been in the market or that were published to the market back in 2012 are very old, and since that time they've been historically coming down over time. We've been writing a lot of new business at wholesale rates, well below the retail rates that were in the product disclosure statement. And if you think back to the numbers from earlier in my session, the $9.5 billion of new money that was written on the last 12 months has absolutely been written at rates well below what would have been retail rates many years ago. So we're not expecting a cliff. We're not able to give you sort of exact detail of what that might look like from a revenue reduction, but we're pretty comfortable with our forecast and certainly with the way that the business is tracking. In addition to, financials being in good shape, we're also really pleased that across numerous industry research houses, Netwealth continues to be cited as the leading Australian wealth platform. So we've been named the #1 platform for overall satisfaction, for our overall client experience, for onboarding experience, for our technology, again, for the 5th year from Investment Trends last Friday. And we're extremely focused on making sure that we retain that leadership from both a technology perspective and also from a service perspective. So if you look at pricing, service and product, which is really, I guess, what drives satisfaction and also success, we're really pleased that we've got a fantastic offering across all of those 3 metrics, and I'd suggest that's also being shown in the extremely strong growth that we're experiencing. From a cost perspective, we called out earlier in the year that we were going to be ramping up our strategic investments into both our IT and also our sales and distribution. And the reason for that is pretty simple. We believe that there is a once-in-a-lifetime, once-in-a-generation turnover of the industry, and we want to make sure that over the next 3 to 4 years, while the whole industry turns over and resets itself, that we maximise our opportunity. In part, that's going to be making sure that we've got enough salespeople out in the street, hand-to-hand combat and winning deals, but also making sure that we're continually investing into the platform, stretching, I guess, what the traditional definition of a platform is from a technology perspective, and maintaining that significant leadership. In the IT team now, we're growing up to 106 developers and business analysts in that team. And for the first time, we've expanded our development team offshore, and we've set up a dev centre in Vietnam. Key reason for that is that we're finding it incredibly difficult to scale up with talent in Melbourne. There's a lot of very successful tech companies there. There's Xero, REA, MyOb, CultureAmp. So there's a lot of people looking for fantastic talent. We did a search around the globe and believe that Vietnam, thanks to the time zone, but also the quality of the other developers over there, was a really obvious fit. So we've been able to find great people. We're able to scale up rapidly. What would normally take us maybe 6 to 12 months, we can achieve in the space of 2 to 4 weeks. And more importantly, we've also seen a reduction in the cost of those developers as well. So we're expecting around a 35% reduction in the cost of our development scrum teams. And finally, we've got exceptional cash generation. We remain 100% debt-free. We don't expense everything, so you've got very high, if not total cash conversion. Sorry, what was that, Grant? We do expense everything. Sorry, we do expense everything, and we have extremely high cash conversion as a result. We've just announced our interim dividend of 6.9 cents, and that's payable on the 26th of March.